Hey everyone, welcome. It's great to have you back. And today we are building on everything you learned in episode 1. This is episode 2, part 1. And today we're going a little deeper. If you watch episode 1, you already know what pace we are moving with. Slow, structured, intentional. The way ICT concepts are meant to be learned. And if you haven't watched episode 1 yet, I highly recommend beginning there because everything we are doing today builds directly on that foundation. And before we get started, yes, this is part 1. Because liquidity is such a core pillar of ICT that you simply can't rush through it. So I'm breaking this episode into 2 parts to make sure you actually understand it. Now, let me be honest with you for a second. I know what it feels like to be on the other side of the screen, trying to learn ICT and feeling overwhelmed. I've been there. I remember watching hours of ICT's content, and there were moments where you talk and talk and talk before finally getting to the point. And here's the thing, all the talking was building the understanding I didn't have at that time. And that's why I take my time with these explanations too. And yes, I will talk a lot, but I promise you guys, I'll keep everything to the point. So no fluff, just what matters. Because I'm not here to speedrun charts at you or fire off terms hoping something sticks. I want you to understand the logic the way it's meant to be understood. So do me a favor and do yourself a favor too. Grab a notebook, take notes, write things down, because what you write, you remember, and what you don't write, you'll forget it tomorrow. All right, today we are stepping into one of the core pillars of ICT concepts, liquidity. Not the watered down version that you see online, but the real mechanics, how liquidity forms, how it's engineered, why it gets taken, and how the algorithm moves price from one pool to the next. Just so you know, we've got a bunch of chart examples coming up. So lock in, stay focused, take your notes, and let's break down liquidity the right way. All right, guys, let's begin this episode 2, part 1. Before we go any deeper, we need to settle this one idea because everything in ICT builds from it, liquidity. And here's the truth, most traders simply never slow down to understand. Liquidity is nothing more than resting orders. Buy stops resting above all highs, sell stops tucked beneath all lows. Simple. But here's where the entire retail mindset falls apart. Whenever price forms a high, retail labels it as resistance. Whenever it forms a low, retail call it support. They see these points and think, price should react here. It should respect these levels. But what is actually happening? Those highs and lows are magnets. They are targets. Because above every high is a pocket of buy stops. People getting stopped out and breakout traders trying to chase the move. Below every low is the exact same story, just flipped. Clusters of sell stops waiting to be collected. So now you've got 2 groups, the traders getting stopped out and the traders trying to catch a breakout, all piling into the same areas. And what does that form in the market? Liquidity pools. Now you understand what liquidity pools really are. They're simply clusters of resting orders. And here's the part most beginners never get told. The algorithm does not care about your support and resistance. It isn't respecting levels. It's looking for fuel. And the cleanest, richest pockets of fuel are sitting right above the highs and right below the lows. So when you shift your perspective, when you stop seeing high as resistance and start seeing the buy stops sitting above it, everything starts to click. Same with the lows. They are not support levels. They are simply sell stops. And once you understand that price is drawn to the orders behind the levels, not the level itself, you are no longer surprised when price runs those highs and lows, because now you know exactly what it's reaching for. Now, here's the part most traders never understand. Price isn't running around the chart. It has a purpose, it has an objective, and that objective is liquidity. Liquidity is what the algorithm needs before it moves. Without those resting orders, nothing meaningful can happen. There's no delivery, there's no displacement, there is just no narrative. So when you see price making its way into the direction of a high or low, it's not because the market is testing levels. It's doing exactly what it was designed to do. Seek out the next pocket of fuel. That's what liquidity is, fuel. It's the energy the market needs to deliver price from one area to the next. And once you understand that, every swing, every run, every push into an extreme starts to make sense. Price will move into a pool of liquidity, harvest those resting orders, and only then does the next phase of delivery begin. This is the part beginners never see. They think price is reacting emotionally. They think it's respecting support or resistance. But the truth is much simpler. Price is targeting liquidity on purpose. It's intentional. It's systematic. It's baked into how the algorithm operates. And once you understand that liquidity is what drives price, the guessing ends. You start to see the intention behind every sweep, every run on a high, every rate beneath a low. This is why liquidity matters. Because once you see that price is repeatedly hunting for the next pool of orders, you start to understand the entire delivery model. All right, now let's break down the different types of liquidity you'll face in the market. And before we get to the charts, I want you to clearly understand what each one stands for, because this is where the entire narrative of price delivery begins. So first we have buy-side liquidity, the buy stops standing above all highs, the sell-side liquidity, sell stop tucked beneath all lows. These are the most obvious targets on the chart, and the algorithm seeks them with purpose. Next, you have built-up liquidity. This forms when the market prints equal highs or equal lows. Retail sees strength. They think the levels is being respected, but in reality, every touch is adding more stops, building a larger pool of liquidity just waiting to be taken. Then there's resting liquidity, all highs and lows. That price hasn't cleared yet. They sit there quietly, untouched, almost inviting the algorithm to come back to them. And more often than not, it does. And finally, engineered liquidity. This is the consolidation, a tight compression, the temptation, or should I say inducement, the algorithm creates on purpose. It lowers the ranges for stops, it builds pressure, it prepares the fuel required for the next move. So when you start recognizing these types of liquidity, you stop seeing noise, right? You will start seeing the intention. You begin to understand why price is being drawn into certain areas and why every run, every sweep, every shift in delivery happens exactly when it does. All right, guys, let's walk through this example of buy-side liquidity because this chart shows the retail trap perfectly. So on the left, you see I've drawn a line showing buy-side liquidity. Retail traders look at that level and right away treat it like resistance. So they draw their zone, they wait for reaction, and the moment the price hesitates, that becomes a signal to enter. They sell and they place their stop losses right above this high, right where all the buy-side liquidity is sitting. For a brief moment, price moves in their favor. It gives them enough confidence to believe the level is holding, but then the market turns around, runs the high, and stops them out. Their stops become fuel for the algorithm, but it doesn't stop there. Remember, there are buy stops above that high. So breakout traders have orders resting there. As soon as those buy stops get triggered, price snaps back lower and they get stopped out as well. Now, retail traders get trapped again. Price begins hovering just below this new high, And this is where they convince themselves that the next move above this high will finally be the breakout they've been waiting for. So they placed the buy stops again above this new high, expecting that push to the upside. Price reaches up, takes the high, triggers the entries, and for a moment they move from drawdown into a little profit. They think this is it. Now we should expand higher. But look at what actually happens. The algorithm collects the orders and sends the market straight down. Now, every trader who sold from so-called resistance, every breakout who bought the high, every stop setting above that level, all of it becomes fuel. This is the real meaning of buy-side liquidity. It's not a breakout, it's not resistance being respected. It's the algorithm harvesting every stop in that zone before delivering price lower. Now, here's a simple example of sell-side liquidity. On the chart, you can see this low. Right below it, there's a pool of sell stops, traders protecting the long positions, and breakout traders waiting for a move lower. Price trades into this level, sweeps the low, and this sweep is all the algorithm needs to trigger every sell stop resting in this area. And once those stops are taken, watch how price immediately reacts from the zone and begins to deliver higher. And here's the important part. The market wasn't breaking support. It wasn't falling apart. It was simply reaching into the sell side liquidity, collecting orders below this low, and using that fuel to move away. That's all sell side liquidity is. It's a target. It's a pocket of sell stops the algorithm draws price into before delivering in the opposite direction. Now, take a look at this example of built-up liquidity. You can see the market forming equal highs at the top and equal lows at the bottom. Whenever you see this kind of structure, it tells you something very straightforward. Every time price taps those levels, stops are stacking up. Retail looks at equal highs and calls it strong resistance. They think the market is rejecting that area, but every touch is simply building more buy stops above that line. Same thing with equal lows. Retail sees support. They think the market is holding, but beneath that level, a growing pool of sell stop is forming. This is why equal highs and equal lows matter so much. They are not showing strength. They are showing build-up. They are showing where the algorithm has layered pockets of liquidity that is eventually going to reach for. And the clearer those highs and lows look, the more liquidity is sitting behind them. Sooner or later, price will reach into one side and clear the pool of stops and then deliver in the opposite direction. That's the real meaning of built-up liquidity. It's not structure holding, it's liquidity accumulating. Alright guys, let's look at how this engineered liquidity forms. See how price starts moving sideways. It's not trending, it's not breaking out, it's just sitting inside a range. And as it moves back and forth, it keeps doing behind these clean swings, highs forming on one side and lows forming on the other. Every time price tags those levels, it leaves more stops behind. So this isn't a strong level or anything like that. It's the algorithm building liquidity on both sides of the range. A range the algorithm uses to stack orders on both sides. Now, here's what happens next. Price reaches down, takes the engineered sell side liquidity first, but that's the easy liquidity. So price continues lower and reaches for the old low sitting beneath this range. The old low is a real pool of sell stops. Once that gets taken, now the algorithm has everything it needs. And that's when the buy program kicks in. You can see the reaction immediately. A clean, sharp move in the opposite direction. As the buy program starts pushing up, your attention should shift straight to the other side of the structure. Then engineered buy side liquidity that was forming earlier. Those repeated highs, those stops building above them, that becomes the next target. And then what happens next? We get this retracement, and after this retracement, the price drives right into the buy side liquidity and sweeps the entire top of the range. Now, here's the roadmap the algorithm just followed. Liquidity is built, the engineered liquidity sell side gets taken, old low unlocks the real move, and price finishes by clearing engineered buy side at the top. Now guys, just remember, this is a very simple example. Engineered liquidity can become much more complex than this. Different ways it can form, different structures, and different ways the algorithm traps traders before the real expansion. I'm keeping it clean. I'm keeping it clean here, so you're not taking it more than you need right now. Part 2 is where we break down engineered liquidity the way it's meant to be understood. Why the algorithm builds it, how it uses it, and how you can start recognizing it before the move happens. But for now, this example gives you the perspective that makes the whole thing make sense. The deeper layers comes next. The daily liquidity cycle. Right guys, before we step into the charts, please understand this. What I'm showing you here is only one scenario. Sessions won't behave like this every day. They shift with the narrative. So I'm using one clean example here so you can see the logic clearly. And we'll break all of that down when we move into the session focused episode. Okay, now let's take a look at the chart. You can see the sessions marked here: Asia, London, and New York. In the Asia session, you'll usually see price sit in consolidation, slow movement, tight range, nothing to trade, nothing really happening. That's the market building liquidity. When London opens, you'll often see the first meaningful move. In this example, price reaches down, takes the Asia low, and the moment that liquidity gets taken, London gives a strong expansion higher, clean, decisive, no hesitation. As we move into pre-New York and early New York session, price starts to slow down. The market's just pausing after London's move. Then we finally get the retracement. Price trades back into this bullish fair value gap inside London's range, and from there it catches a good push higher to continue the move. So in this example, the flow is simple. Asia builds liquidity, London takes liquidity, London expands, New York rebalances, and the move continues. The true objective of price, the draw. So when I say price moves into liquidity, I'm talking about the idea that price is always traveling into a pool of resting orders. That's the destination. That's the draw. And most of the time, the draw sits on the higher time frame. ICT always emphasizes the higher time frame draw because that's where institutional order flow lives. That's the narrative the algorithm is delivering price into. So when you see all the intraday movement, the little sweeps, the small runs, the pushes, that's just price cleaning up what's sitting in front of it. So it can make a clean delivery into that larger objective. Price doesn't react randomly. There's intention behind it. There's a target it's being pulled into. All right, now let's bring your attention to the bigger picture, the draw. We've already walked through the intraday flow on this chart in the last slide, so I'm not going to repeat any of that again. Instead, I want you to look at why price moved the way it did. Everything you saw, the Asia range, the London sweep, the expansion, New York retracing into the 50-minute fair value gap, and price expanding higher. All of that was simply the path into the next pool of liquidity. And in this example, the draw was the 1 hour imbalance, sitting above the market. This is the part most traders miss. They study the intraday moves, they stare at every candle, but they never ask the real question. What is price reaching for? What's pulling it? Now, this 1 hour imbalance is what the entire day was delivering into. It's the magnet, it's the destination, it's the reason the bullish delivery made sense. So here's the logic. Price clears what it needs to clear. It rebalances along the way, and then it makes a clean push straight into the draw. This is why ICT always says, price seeks liquidity. It's intentional, it's mechanical, it's algorithmic. Right guys, before we wrap this up, let's just slow down for a moment. We've gone through a lot in this lesson, and I want to make sure it actually sticks. You now understand what liquidity really is, why price goes after it, how it builds, how it gets cleared, and how the algorithm delivers price into the higher time frame draw. These are the building blocks. If these don't sink in, everything later becomes harder. Now, part 2 of this lesson will be out next week. And that's where we go deeper. We look at why some liquidity is easy to clear, why some levels resist, and how those engineered moves happen right before the real direction unfolds. But I don't want you to just wait for part 2. Use the next few days to study this properly. Open your charts and go hunt for everything we talked about today. Go and find equal highs, the equal lows, the consolidation, the sweeps. Find where price delivered into the higher time frame draw. Mark it, screenshot it, replay the price action if you have to. And trust me guys, this is how it clicks. And when part 2 drops next week, you'll understand the deeper mechanics with much more clarity. Right guys, that's the end of episode 2, part 1. And honestly, thank you for being here. These foundation lessons aren't flashy, they're not exciting, and most traders skip them. But this is the part that actually matters. If you've stayed with me all the way through, it tells me you're serious about learning this properly, patient enough to understand the narrative, and willing to build the right lens before anything else. And I respect that. So everything we covered today, liquidity, how it builds, how it gets cleared, how price behaves around these pools, this is the groundwork, the part every trader needs before anything deeper. So guys, if you need PDF for today's lesson, it'll be inside the Discord. The link is in the description. And before you go guys, please go ahead, like the video and subscribe if you haven't already. It really helps the channel grow. So take care, have a good week, and I'll see you in part 2 next week.